Before you're ready to trade stocks, you must first understand the different stock market order types available to you. Most people are familiar with market orders, but aren't aware of the other choices that they may have that may lead to higher gains. Aside from market orders, you have limit orders and stop orders. There's a right and wrong time to use each order type, and understanding all three and when to use them can help you reach your investment goals. Let's go. Hey, this is Carlos with Influential Finance, and on this channel, I make weekly videos to help you improve your personal finances. So if you're new here, consider subscribing. Let's first start by talking about market orders. A market order is an order to buy or sell a stock right away at the best available price, which is the highest price for the sellers and the lowest price for the buyer. There's no guarantee at what price the transaction will take place. It all depends on how quickly the order takes place, which in a best case scenario should be immediately. You should place market orders during market hours, which is 9:30 a.m. to 4 p.m. Eastern Standard Time. Your goal is to buy or sell stock at its current price. As a seller, you look at the bid price, and as a buyer, you look at the ask price. Most market orders that are placed within the market hours execute instantly, giving you the closest price to the market price that you saw when you initiated the trade. Let's move on to limit orders. A limit order specifies at what price you will buy or sell your stock. You can place a buy limit order with a specific price that you want to pay for the stock, and your order will be executed if the stock hits the price that you have set. Likewise, you can place a sell limit order with a minimum price that you want to sell your stock for, and your stock will be sold if the price of the stock hits that limit price. The order will only get executed if the limit price is hit. If the limit price that you set is not reached, then your limit order will not be executed. Here's how a limit order works. Let's say, for example, a stock's current price is $150 per share, but you feel like it will go down. You only want to buy the shares when it drops to $140 per share. You can set up a buy limit order, and if the stock drops to $140 or lower, your order will be immediately executed. If it never reaches that target price, then your order to buy the stock will not be executed. You can also place a sell limit order. You do this if you think the price of the stock will increase and you don't want to sell at the current market price. Using our previous example of a stock trading at $150 per share, let's say that you think that the stock will increase to $160. You can set up a sell limit order at $160. This means that you will continue owning the stock until it goes up to $160 or higher. When the stock hits $160 or higher, your limit order will be executed and you will sell your stocks to cash in your profits. There's a caveat though. There's no guarantee that your order will go through. Limit orders are placed on a first come, first served basis. If there aren't enough shares to go around, you may not get your orders filled. And lastly, there's a chance that your limit price may never be reached, causing your order to never be filled. Typically, people are familiar with market orders and limit orders, but aren't too familiar with the next order type that we will cover, which is stop orders. For stop orders, we have two different types: a stop loss order and a stop limit order. Let's first talk about stop loss orders. A stop loss order is a combination of a limit order and a market order. The stop loss order states that if a stock reaches a specific price, the stock should be traded at the next available market price. If the stock doesn't hit the stop price, there's no order to execute. Hey, if you're enjoying this video, can you please hit the like button and subscribe for more weekly videos just like this one. Alright, let's get back to the video. A stop order for sellers offers a level of protection. It gives sellers a chance to say, sell the stock if it hits this price. As a seller, you would use it if you felt like the stock prices might fall. For example, if your stock is trading at $150 right now, but you see some news that tell you that the stock will fall, you can protect your investment by setting up a stop order at $140 per share. This will limit the amount of money that you will lose if the stock does indeed fall. If the stock hits $140 per share, your order becomes a market order and trades at the next available price. As a buyer, you'd use a stop order if you think prices might rise. You can create the stop order to grab the stock at a specific price and then enjoy the ride up as prices increase. Using our $150 per share example, let's say that you set up a stop order at $160. If the stock takes off, your stop order will be triggered when the stock hits $160. The stop order automatically becomes a market order and will be executed at the next available market price. Right now, you might be thinking that a stop order and a limit order sound very similar, and they are somewhat. Let me explain. The main difference between the two is that with a limit order, you are specifying a price that you want your order to be executed. However, with a stop order, your order to buy a stock will turn into a market order once your price target is hit. To take it one step further, your stop order can also become a limit order once your price target is hit. This is called a stop limit order. Like I mentioned previously, a stop order turns into a market order when the stop price is met. However, with a stop limit order, once the stop price is met, the order will turn into a limit order. Instead of just triggering a transaction at the market price like a regular stop order, a stop limit order has a stop price and a limit price. They can be the same or different. In order for the transaction to take place, both the stop price and the limit price must be met. If only the stop price is met, but the stock doesn't hit the limit price, your order will not be executed. Trading stocks requires a lot of decisions. Having help is important so that you don't make emotional or impulsive decisions when the market makes big shifts, which it does very often. You can control at what price you buy or sell by setting up specific orders rather than going with market orders for all of your trades. That pretty much wraps it up for this video, but if you'd like to watch more videos on my channel, I'll leave more videos linked right over here. And as always, make sure you click on my face right here to subscribe for more weekly videos. That's been it. I'll see you in the next one. Peace.